Marat, thank you so much for joining me for this interview. How are you? How have you been?
Yeah, I'm doing okay, thank you.
How have things changed this year for you, actually?
Yeah, so let me talk to you a little bit briefly about myself and also my company. So my name is Marat Molyboga. I'm the Chief Risk Officer and Director of Research at Efficient Capital Management. And since our inception about 20 years ago, we have been specializing in building customized multi-manager solutions for institutional investors. So when I typically think about what happened this year, I tend to think about the world of multi-manager customized solutions. Also, I have a fun part-time job. I'm an adjunct professor of finance at the Illinois Institute of Technology Stewart School of Business, and I consider myself to be a geek. I like thinking about quant finance. I like thinking about machine learning techniques, and I look forward to going to the Quant Minds events next week. So you asked a question about how everything is going, and of course, on a personal level, everybody's working from home. And if you asked me this question a year ago, could you make a prediction of what's going to happen in a year? I would have never predicted that I would be having this interview talking to you from my loft right above my garage, and 3 of my kids would be studying downstairs doing online education. My kids are 11, 10, and 6. So all of them are doing education remotely now, which is very common in the US. So, but when I think about the financial markets, I describe this year as March Madness. And not only because the college basketball championship was canceled for the first time since 1939. It's something that Americans would know, maybe not people in London necessarily. But when you think about what happened in the financial markets, the stock market made all-time highs in February of this year. And then we saw the biggest 5-day drop since October of 1987, and the biggest 20-day drop since the Great Depression. So we saw some very massive moves in the financial markets. And also, the typical flight to quality relationship of stocks, bonds, and US dollars completely fell apart, and that is also madness. And when you look at what happened in April, oil futures prices went negative, which is also hard to imagine. That's also an example of madness. And then finally, when you look what happened in July, the Fed chair, Jerome Powell, said that the Fed was going to keep the rates low for as long as needed to overcome the coronavirus pandemic. And to me, that's also crazy because Fed cannot do much. It can only print money, but it cannot print jobs. It cannot print the economy. It cannot fix the solvency issues of businesses. So when you think about the financial crisis of 2008, it was a credit crisis. And what we're seeing now is really more of a health and a logistical crisis, and the Fed cannot do much. But as we speak, the stock market is close to making new highs. So to me, that's also an example of madness. So we'll live in the world of March Madness.
So with all this governmental intervention and support, so ultimately speaking, is that a positive or a negative thing?
Well, that's a great question. So I think there are lots of opinions. If you look at how different central banks around the world decided to intervene, you'll see a very different reaction from the Fed versus the UK central bank. So I don't think there's a consensus. And if you look at the whole idea of lockdowns, you can see that, for example, in the UK, there was one strategy was pursued of trying to isolate older people, and then there was a complete reversal around the same time that your prime minister got coronavirus himself. If you look at Sweden, they decided to pursue a strategy of herd immunity. And whereas, in the States, you can see some lockdowns, but also a lot of people who are happy or unhappy with those decisions. So from my perspective, I think that unfortunately, this issue is highly politicized. And I think that what we need to do, we need to come together and think about what makes sense from the perspective of the economy and take the steps that are required to succeed as a society in overcoming this crisis. But I don't think we're really seeing that, unfortunately. So when I think about pandemics, I think that the biggest thing we need to think about is that how do we actually reduce the spread of the disease, right? Because particularly early on, you saw that the growth was exponential, right? And the hospitals were overwhelmed. So there's a way for us to take maybe some simpler steps, such as wearing masks or maybe doing some social distancing, then we don't have to go all the way to complete lockdown to overcome the issue. So I guess I always have to, I always think in terms of like, what's the cost, what's the benefit, and do that analysis to figure out which actions make sense from the economy perspective. So all I have to say is that I don't think there's like one correct answer and one correct opinion, but from my perspective, I think that we need to think about what's the dynamics of the pandemic and how do we actually think about cost and benefit of the actions we can take and make the right decision based on the cost benefit analysis and not driven by politics or other factors.
Is there anything that maybe financial institutions could do to help?
Well, that's a great question. So I think that I'm actually seeing there are quite a few institutions that are involved in trying to help. For example, so one of my classmates from college, he's the CEO of XTX, which is a market making firm in London. And I think that he personally and his firm, they've donated a lot of money to help overcome the COVID crisis. And I know there are a lot of other financial institutions who are stepping in and helping, which is great. I think also we should recognize that the work we do is really important for the economy. And I think that just us doing our job, whether as investment professionals or risk managers or quants, I think is important because I think we need to play our part in providing liquidity to the markets by helping hedgers, by helping retired people secure their retirement. Like if you look at in the US, there's a very significant issue among public pension plans. There's a very huge gap between assets and liabilities, and to me, it's a personal question. My mother-in-law spent many years of teaching in the state of Illinois, and she retired a few years ago. And I worry about her retirement because the Illinois teacher retirement system is only 40% funded, and if there's a crisis that happens, I worry that she might lose her retirement. So I think it's up to all of us as investment professionals to think about how we can actually help creatively, how we can build products or come up with some investment solutions that can help public pension plans in the US or maybe some endowments or some other organizations, because what we do on the investment side has implications for ordinary people like you and me and retirees like my mother-in-law.
So with all these changes and all these very various positions and conversations going around, can you pinpoint maybe the one biggest lesson that you've learned this year?
So I guess it's not necessarily a new lesson, but I think it was helpful to apply this year. I guess the big lesson is that you need to know what you don't know. And when I think about what happened this year, is that from a multi-manager perspective, we've seen a huge return dispersion across managers' performance. And just to give you put in perspective, typically when you look at quant managers, an annual return dispersion of 30 to 40% is pretty common. And we've seen a comparable return dispersion just in 1 month in March. And then the question is, okay, what do you do about it? How do you evaluate managers? And I've heard some people say, well, it's all about your performance during crisis that indicates whether you're being skillful or not skillful. But I guess what we've tried to do as a company, because we invest in so many different managers, we decided to be deeper and not just look at absolute performance of those managers, but really we took a lot of time to understand the drivers of that return dispersion. And actually in June of this year, our CIO gave the whole webinar on the return dispersion. But I'm going to mention a couple of factors that we found important. One, of course, is the choice of strategy. For example, trend managers on average did better than those who rely on carry trades. And if somebody was involved in volatility selling, which a strategy I don't particularly like, we've seen a number of those managers, not in our portfolio, but in our industry, who actually ended up going out of business because volatility selling strategies blew up in March of this year. So the second factor is sector location. So those managers who chose to invest in commodities really struggled for the last few years. However, this Q1 was a fantastic period, fantastic environment for commodity managers, whereas those who traded financials, such as equities and fixed income, got hurt by the reversal because the markets was at equity highs in February and got crushed in the last 20 days. So it was really a tough environment for those managers who chose to only trade equities. Time frame. If you look at our space, short-term managers in general had really struggled since the global financial crisis. And if you look at the SocGen Short-Term Traders Index, which is a really good proxy for the space, it performed very poorly for the last 10 years. But this was a great time period for short-term managers in Q1, and we saw that our short-term managers were some of the best performers in our portfolio this year. So I guess the point is that, one, you got to understand what drives your performance, but also you got to think about diversification. There's this theme that if you move away from short-term managers because they're not so great performance lately, you might lose out on diversification benefits from them during crisis. Or if you choose to avoid investing in commodities because of tough environment, then once again, things are going to change and you would have missed an opportunity that commodity markets saw in Q1 of this year. And finally, the role of luck is important. So our CIO talked about one particular example of how if you change the look-back period of a simple trend strategy by only 8 days, then the performance implications would have been about 400 basis points in Q1 of this year, which is a pretty massive amount for such a short period of time. So I guess the lesson we've learned is that, well, one, diversification is important, and two, you got to be careful about listening to what people say about what's predictive of performance, but really you got to do the hard work of opening up the hood and understanding the return dispersion and evaluating which factors drive performance of managers and understanding, what comes from skill, what comes from luck.
With this in mind, how do you see the future of quant finance and risk management even? Yeah,
well, that's a great question. A lot of dreaming about the future. And typically when I think about the future, I think about machine learning. But I guess I'm going to share some observations and maybe suggestions that I would give to investors who decide to invest in the managers who rely on machine learning techniques. Because I have this multi-manager perspective, and hopefully it's going to be relevant for institutional investors as well. So the first suggestion I would give is know what you know and know what you don't know, because it's never a good idea to fool ourselves. We never fully understand the strategy of a manager, but what we can do is do our best to open up the hood and try to evaluate how thoughtful is the thought process behind the strategy and have a general idea of when the strategy is going to be expected to perform well or poorly. That's really the best we can hope for. We can ask which machine learning techniques are used and why. We can ask about which regularization techniques are used to overcome overfitting, which inputs or features are used and why. Talk about the challenge of interpreting signals of the strategy, and an investor can learn a lot about the manager by how to respond to those questions. We don't want a strategy to be a complete black box, but we also need to be honest with ourselves and recognize that we don't fully understand it. And second, machine learning is such a buzzword. And I like simplicity. If a machine learning technique gives the same signals as a traditional carry trade, I would go with a simple carry trade. I rely on the principle of it's better to be approximately right than precisely wrong. Finally, I think that machine learning is here to stay, and I think it's a tool that all of us really need to get comfortable with and to understand better when it should be used and how it should be used. And the suggestion I would give to investors is try to learn and try to change the balance of what you know and what you don't know.
I have a final question, if you don't mind. I know you said that you have your family downstairs all learning, so your 3 children all learn online learning and such. But being at home it could be quite difficult. So what has been keeping you sane for the last couple of months?
Wow, that is a great question. What has been keeping me sane? Well, I'm going to share a few things, and of course, I think one, it's important to do what you're passionate about, and I love the area of investments and finance. But also, I think it's important to have other interests as well. I mean, we're human beings. We're not machines. We're not econs. We're humans, right? So I love sports. I started playing pickleball recently with some of my friends, and I've been fascinated by the chess world championships that we've seen lately. Just the last few days, there was like a chess 960, which is a really interesting version of chess that was happening, and it's actually very fascinating how the world has changed outside of finance as well. Like if you look at chess, there were actually several games of world caliber games that were lost because of misclicks of a mouse, right? So the games were decided just by some really silly things that would have never imagined even a year ago, which is really shocking. And so I would say sports, chess, books. I love reading books. And I started coaching my youngest. My youngest is 6 years old, and she started playing soccer with her friends. So I'm coaching her team, and it's really fun to spend time with children and help them learn to get better and get more comfortable. So we talk a lot about their success in any game being determined by 3 factors. We need to play hard, we need to be good sports, and we need to have fun. And if we accomplish those 3 things, it's success regardless of the score. So those things help me stay sane and make me feel fulfilled and excited about what's ahead.
All right, well, Marat, I kept you long enough. Thank you so much for joining me today, and I will see you at the event next week.
Sounds good. Well, thank you very much. Bye-bye.